Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to briefly touch on the latest Canadian CPI release. We have kept a keen eye on inflation because we have been worried about a possible resurgence in the figures, and thus far, we've been proven right. This will lead us to an important topic that is dominating our investment committee meetings here at IceCap, and that is of budgets and bond yields. So let's get right into it. In truth, the headline figure for the June CPI release doesn't look too bad and was in line with expectations. Inflation rose to 1.9% on a year-on-year basis in June, rising from the 1.7% increase we saw in May. And this means for nearly a year now, headline inflation has been within the BOC's inflation control target range of 2% plus or minus 1%. Quickly, a reminder as to why expectations matter so much. Well, because how far away the fresh data point deviates from the consensus estimates can impact the markets. If it comes in too high, then a central bank might be seen as being behind the curve. If inflation is well below expectations, then a central bank might be deemed as too hawkish, or that monetary policy is too tight. Currency and bond markets will then quickly react, incorporating this new information. So if inflation came in as expected, what's the big deal? For investors, and if I'm so bold as to presume the Bank of Canada, it is that underlying inflationary pressures refuse to go away and might be re-accelerating. This is putting upward pressure on short-term bond yields, so it will have an impact on future budget decisions, as well as weigh on assets like real estate and the equity market. One way to support the conclusion that inflationary pressures are starting to rise again is the following chart of the BOC's 3 preferred measures of core inflation. These less fickle measures really help to drill at the core, pardon the pun, of what's really going on with consumer prices, and as you can see, they are rising again. The second chart might even be more damning. It shows the breadth of inflation. Here we can see the scope of inflation across the CPI basket expanded in June, with approximately 55% of the components showing an annualized 3-month inflation rate exceeding 3%. This marked the broadest inflationary pressure observed so far in 2025. The combination of these two means that not only is the median CPI component rising, but so too are a plurality of the consumer basket components. So what does this mean for the BOC and Canadian? Well, given the BOC's single mandate, targeting inflation, rising core and breadth measures seem to be holding up the path of future interest rate or expectations. Those little dots on the chart, which are based on overnight index swaps. As you can see, they have flatlined. All the cuts that were priced in just a few months ago have disappeared. The market is increasingly convinced that the rate cut cycle is over. Accordingly, this also means that for now, mortgage rates are rising. Another way to see what's transpiring in the bond market is to examine the yield curve, or in simple terms, interest rates at different maturity. Each maturity reflects similar but different investor appetites and tells us different things about the expectations for an economy. Now, very simply, the front end or short end of the curve is based on monetary policy expectations, and the long end is more about growth, inflation, and credit quality. To be clear, this is a highly simplified explanation of a more advanced and sophisticated concept, but the chart does a good job showing the change in sentiment, blue versus green. All bond yields along the curve have shifted higher. So as we round out this week's video, I want to be clear that rising bond yields is a global phenomenon. And this is because much of the rich world share the same problems and issues. There's way too much government debt on the books, there's not enough organic growth or productivity, and there's zero appetite for austerity or the courage from politicians to rein in spending. The latter point is most evident in places like the US, the UK, Japan, much of Europe, but Canada too is falling down this path. In episode 34, we discussed the resignation of the former finance minister over the exploding budget deficit and we made clear that the forecasts were not to be trusted. How quickly we were proven right. The expectations for this year's budget are exploding. The latest estimates are for $90 billion, but we wouldn't be surprised if it cracks $100 billion. Of course, under the guise of tariff threats, any pretense of fiscal responsibility has long been dispensed with, and all kinds of profligacy is now welcome and even encouraged. We think this is very short-sighted. This is because despite the desperate attempts of some politicians to convince us otherwise, any kind of deficit spending means adding to the debt burden, and that debt has to be paid back, either through higher inflation or more tax revenue, eventually. And in the meantime, it must be serviced. We call this interest payments, and they are related to yields. The problem Canada faces is that debt levels are very high, and much of that debt must be reissued and refinanced over the next few years. This means that the debt charges or interest payments will continue to rise because debt will be refinanced at much higher bond yields. These higher borrowing costs for the public and the private sector bring on debt servicing challenges. For governments, this could lead to even higher deficits or austerity measures down the road. And for much of the private sector, higher government bond yields means higher mortgage rates. From an investment perspective, these are just two of the negative implications of rising bond yields. One of the others is the impact on asset prices. Higher yields means tighter financial conditions, and this could potentially lead to a sell-off in equities at a time when equities are extremely expensive relative to history and earnings. Real estate and other interest rate sensitive assets may also decline in value. Those tighter financial conditions are only part of the story, of course. If yields rise too quickly, it can trigger a panic and potentially trigger a recession by reducing consumer or business confidence. And finally, how we got started in this week's video, inflation expectations. Rising yields often reflect expectations of higher inflation, which can erode purchasing power and create uncertainty for the economy. As we go forward this year and probably next, rising bond yields across the yield curve, but especially for longer-term maturities, is something we at IceCap are keeping a keen eye on. We think there are all kinds of issues that can flow from this, as well as panics and crises in the sovereign debt market, and we are positioning our portfolio to take advantage of this eventuality. All right, that's a wrap on this week's episode. Thanks, as always, for watching. Please like, subscribe, and follow for more. It helps me with the algos. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.